Hey guys, Whitney here. Thanks so much for joining me live today. We are expecting a very full house. I'm going to give it just a couple minutes for everybody to file in. If this is your first time joining the Passive Investing Made Simple show, I'm Whitney Elkins-Hutton. I'm the Director of Investor Education here at passiveinvesting.com. And we do this every Tuesday live. Really what we're tackling the ins and outs of passive investing so you can go into your first or next deal with confidence and put knowledge into action. That's really what we're about. At the end of the show, you should be able to walk away with some tangible steps to take in your own investing journey. So with that, make sure if you haven't done so already, join passiveinvestingwithwhitney.com. It's a subpage on the passiveinvesting.com website. There I've got some free goodies for you that you can't get anywhere else on the website. And also you can jump on my calendar and we can talk about our open deals. Now, let me just double check. All right, I think we've got somewhat of a quorum. So I'm going to go ahead and start the live portion of the show. So to kick off today's show, please welcome my dear friend, Jeremy Roll. He is the founder of For Investors by Investors. And Jeremy, I want to start off with a little story of how we met. And
Sure.
It was Best Ever Conference 3 years ago. It was right before COVID. Because I remember I sat down with you. I was like, Jeremy, I want to talk to you. I want to pick your brain. How did you do it? How did you become a full-time passive investor? And I remember part of that conversation, you were like, what do you think about this virus that's going around, COVID? And yeah, here we are, three years later. But it has been such a pleasure to get to know you over this time. You are an amazing wealth of knowledge, and I know you are all over the place talking about, your predictions on the real estate market, how do you vet operators, markets, and deals. But Jeremy, I really would love to focus on kind of your backstory of how your evolution, on how you built your portfolio. What are you looking at? How did you make this transition from working to full-time passive investing? Because that is really, I think, the interesting part of the story that we don't always get to hear. But before we do that, just take a moment to introduce yourself and how you got into passive investing.
Yeah, absolutely. And thanks again for having me on. I hope this is helpful for everyone who's joined us. Thank you for joining us if you're here with us live. My name is Jeremy Roll. I am originally from Canada. I'm actually from Montreal. I've lived half my life in Montreal and most of half my life in Los Angeles. I'm now just a little bit south of Los Angeles. I essentially am what I call myself a full-time passive cash flow investor. So I started down that journey back in 2002, and it was after the dot-com crash, for anyone on here who can remember that. And after the stock market was just up and down 30% in a year, like it just was not the right fit for me for my long-term retirement account. And so I said, I'm just not into the volatility and, frankly, even more importantly, the lack of predictability. So I started to look at different ways to invest, came across the concept of more like stabilized passive cash flow, low risk cash flow for myself, and kind of figured that was a better personality fit. So I started to invest in real estate syndications where they're pulling a lot of people together and your passive is a little, piece of a big deal in 2002, early 2002. And then I ended up rotating all my money from stocks and bonds into cash flow from 02 to 07. And I was working in the corporate world at the time. When I first started, I was at Disney headquarters. When I was back all the way to 07, I was actually at Toyota headquarters. And the truth is, I didn't go on this path to get out of the corporate world. I actually just wanted to have the paycheck and the better retirement, strategy, just better fit for myself. But what happened is I had a last strong moment in the corporate world with a new manager I had. I'd switched divisions at Toyota, and we were not seeing eye to eye, and he was not really helping me to solve stuff. And so I decided to take a risk and leave the corporate world in mid-2007 because I have enough cash flow built up to live off of at that point. And so I've been a full-time passive cash flow investor for over 15 years, but a passive cash flow investor of over 20 years. And that's my quick story.
The quick story, the summation in like 3 minutes of 20 plus years of investing. Well, so I have so many questions based on just what little bit you shared with us, but I want to encourage people that are joining us live, make sure to go over to your Q&A box and drop in your questions there. Whatever we can answer live in the show, we will. If not, we will answer additional questions in our after party section. But Jeremy, I always like to start off with like the what's and the whys, and then we can get into the hows. So what do you define as a full-time passive investor? What does that actually look like? And I think you kind of clued us into a little bit of that definition, but I would love to hear like what you tell people.
Yeah. Yeah, well, to be honest with you, I think it's kind of confusing. So if you tell the average person you're a full-time passive cash flow investor, they have no idea what that means, and I frankly don't blame them. So the easier thing for me to say is I'm a full-time passive real estate investor, and even just easier is full-time real estate investor. Because being a passive real estate investor, a lot of people don't understand, and I don't just invest in real estate, but it's the primary thing I focus on. So it's tricky, and the easiest thing for me to say is I'm just a full-time real estate investor. But in reality, I'm really a full-time passive cash flow investor that also likes real estate, particularly. And that's because I like to invest in hard assets. And it's just a better fit for my personalities. And I think that's a really important point, because for any of you listening who's trying to figure this out and you're new, I'm just a huge proponent of there's 1,000 ways to invest, none of them are wrong. And you got to find the best fit for you. And I really learned that lesson in that I started off almost by default being passive because I was too busy in the corporate world to be active. When I was working at Disney, it was just too many hours. But then when I left the corporate world and I had all this time to at least decide what to do with my time, I still decided to be passive. And I could have made more money being active, and I had the time to be active, but I realized that wasn't the right fit for me. So you really have to find out whatever's the right fit for you and think hard about it. And that's a path I would definitely suggest you go down.
Well, let's dive in a little bit there. So you're sitting here, you realize you step away from full-time employment, you have more time, you could be more active. What made you kind of decide between the two? Like what was happening in your life? And then how would you help others kind of, settle on that question for themselves? Like what should they be asking themselves?
Yeah. So first of all, one of the first things I did when I left the corporate world is actually co-found For Investors by Investors. So just to take a step back on that. So one of the important things you have to do if you're trying to be a really successful, highly diversified passive investor is network. There's ways to do it without networking. You can go onto crowdfunding sites, you become part of investor groups. But if you want to be able to find the opportunities directly and not going through an intermediary, networking is absolutely key. It's the number one key thing. And so, and just to be clear about why, this isn't like Apple stock where you can go on to a whole bunch of like Fidelity, Schwab, and just go and buy Apple stock and do research about it. It's a very private world, unfortunately. And most of the opportunities are still not allowed to be publicly marketed. And so because of that, you have to spend the effort actually doing networking. And so I was doing a ton of networking between 2002 and 2007 in LA. I didn't have kids yet. I wasn't married. And I essentially was going to 2-3 meetings a week, which is a lot in LA because the traffic's horrible, but it was a commitment. And so the first thing I did when I left the corporate was I said, okay, I'm sitting in this meeting now and there's a sales pitch for 2 hours and I'm just here to network. Why am I wasting 2 hours? Because I used to literally sit in the back row and do work from work and wait until the end to network. That's what I did. I brought a whole folder and everything. And I was like, okay, now I have to sit through a sales pitch. I don't want to do this. So I started For Investors by Investors to avoid the sales pitch, but have public networking meetings, right? So that's one of the first things I did. And that was technically active, but it was still along the same string of just be able to network and find more deals as a passive investor, right? Now, as my journey went on, at one point, I had a very big challenge with my younger son medically, and put him in the hospital for about 3 months. And he was on and off for like a few more months after that. And we were literally, my wife and I, one of us was in the hospital 24 hours a day for 3 months. So like on shifts and stuff. And that really honed it. I said to myself, if I was either active or if I was in the corporate world, this was literally impossible, because I'm not sure that somebody would have held a job for me for months, especially not at a larger company in that scenario. And that just reinforced like, wow, this is pretty amazing. It was just amazing I was able to do that. But in the end of the day, I'll tell you how I define active and passive, because I think that's important. To me, when I'm passive, I trade control for diversification. And so if you have control, so say you buy 20 single family homes and there's a third party company you hired to manage them all, you could say, oh, I'm passive, someone else is managing all these properties. But in my opinion, it's still not really passive. You're still going to get a call about which toilet to buy and what to do about this tenant. And do you think this is the right tenant to choose and all this stuff, right? So for me, I'm giving 100% control to somebody else in exchange for diversification. Now, I'm a huge fan of diversification, and I'm able to get diversified across asset classes, geographies, and operators. That's my goal. And if you're going to go down the passive path, but you're not going to get diversified, I think you're kind of missing a very important risk mitigator and almost missing the point of being passive to an extent, right? Because you can actually spread your risk across a lot of things. And so those are some of the things I would tell people to think about. I'd also say that if you like having control and you just have it that way, or you want to invest within a 1 hour perimeter of where you live because you want to be able to drive all the properties, right? Or you have trouble making a bet on somebody else, you know that active is the better fit for you. And there's absolutely nothing wrong with it, right? But if you can get comfortable giving control to somebody else, and you like the idea of putting small pieces across a lot of things, or you just don't have time by default because of work or whatever, then you might want to take a look at the passive side. So those are just some thoughts that, go through my head that I went through to pass along.
Yeah, and we talk about it here all the time on the Passive Investing Made Simple Masterclass, is that the control is the operator of the market and the deal, and that's how you're going to diversify, and you should diversify across those three areas in order to get your time back. Now, I can share so many similar experiences. I mean, where for me, where the true value of passive real estate came into play was when my husband broke his neck mountain biking. And then we found out 2 weeks later, my mom had died, and my world was rocked. I still had 4 or 5 properties in flipping, various stages of flipping or buying whole and burying them out. And I just literally had to pass everything off and pray and hope that property manager knew what I was doing. I was like, you can't call me. No, you can't. But so that's why one of the reasons why I truly love passive real estate. Now, as somebody's kind of considering this journey, getting, whether they're going to leave their corporate job or not, why do you think more people aren't doing this or considering this?
Yeah, I think that there's a number of reasons. First of all, I think there's a lack of awareness. And I personally think, without trying to sound like a conspiracy theorist, that I think a lot of the laws are set up against people finding out about this, right? Because if it can't be publicly marketed, and you can't find it in a billboard or an ad very easily. I mean, the laws have changed since 2015, and there is a little bit of public marketing of it, but for the most part, most of the deals are still private. Most people don't know you can do this. And when you call up your broker at Fidelity and ask what your options are, this isn't one of them, okay? And so unless you're very high net worth, in which case you are offered those types of deals, but that's a different story, and it's very rare, right? So they're making money, and they're differentiating themselves on the stock market and bonds and some other money market and all this stuff. And that's what they're selling you. And they kind of keep the laws that way. So it's almost hard to find out this exists. Now there's a whole lack of liquidity in this space that I think may be a whole different place in 5 to 10 years. But for now, that's still the case. And so some people can't get comfortable with the lack of liquidity, meaning you can't just go press a button and sell your shares in 3 days. It's complicated and it's hard. But I really think the biggest answer is there's a lack of awareness. I do speak to people in the corporate world all the time who make a 5 or 10 year plan to get out of the corporate world by slowly rotating their money into this type of space. And I've seen many people get out over the years, and I love it because it just is a complete life changer. And you don't really realize it because you're stuck in the corporate world in your routine. And then frankly, when you're in my position after all these years, now I take it for granted that I could go and do whatever at any time. I set my schedule essentially, right? And I work very hard still, don't get me wrong, very, very hard, but you're getting control of your time back, which is what you're saying. So, but I do think it's a lack of awareness that people have.
So let's start getting into some of the tangibles. For somebody who wants to scale a portfolio similar, maybe not exactly what you do, but scale a portfolio to the size to where they can step away from their job. What are the first 3 things that they need to stop doing right now, and why?
So if they want to scale a portfolio, so I'm going to add a little ending to that. So if you want to scale a portfolio carefully, okay, then the first thing you need to do is stop ignoring the economy and real estate cycles. Okay. I find a lot of people will come to the table from the corporate world and say, okay, I finally built up enough money to start this process. How do I find investments today? And I would say stop and think about where we are in the cycle, develop your own opinion about the economic cycle and the real estate cycle, and determine if it's the right timing, okay? Because I'll give you the very easy example everybody can understand. I mean, you can invest in the best property in the best location in downtown Denver on the best street in 2007 with the best operator and be foreclosed in 2010. And you can invest in the worst property with the worst operator in somewhere in Colorado, in 2010 and make a boatload of money by 2017. And that is just pure timing. Okay. Real estate cyclical, the economy cyclical, those are very important factors. So I would say stop focusing necessarily on the timing that works for you when you're about to start, and start focusing on what the market's telling you, whether you should be going in at that timing or not. I think that's number one important thing. Number two important thing to stop, especially if you're new, is stop worrying about all different asset classes. Okay, so don't worry about whether you should be in self-storage and mobile home parks and senior living and an office and all this stuff. I would say just hone in on one thing. And I always tell people, like, and by the way, I'm not a financial advisor or anything, just my perspective as an investor, but I tell people start with the asset class you can understand the best. If you grew up in a mobile home park or a mobile home parks, I would say start with that. You're going to understand it immediately the best. You'll understand how it works, and you'll already be ahead of the game on understanding it. A lot of people tend to start with apartments because they've lived in apartments, they can understand apartments, and they understand the business model. Learn that one thing first, dip your toe in a couple times on that asset class, and like 80% of what you learn in whatever asset class you choose will probably be transferable to almost everything. Okay, and then you tweak it from there. So I would say stop worrying about all these different asset classes you see out there if you're going to meetings or if you're looking at podcasts, and start focusing on one thing. That's really, really important. And I would also say, just stop looking at deals that aren't the right fit for you. I think you can it's good for learning for a little bit, but I think it's a waste of time. And I think for some of the wrong personalities, you will get distracted and possibly go into the wrong things for yourself. So I would say stop doing that and start creating your box. And what I mean by my box is I have a very well-defined box of what I'll invest in depending on each asset class. So for example, for apartments, I much prefer to be in 100+ unit apartments and even 200+ unit apartments. I won't look at an apartment deal that's less than 50 units probably at all, right? Mobile home parks. That number is 75, that cutoff for me. Prefer over 100, probably won't look at one that's less than 75 unless it's a unique circumstance. Self-storage, I'll probably look at 300 units or more and prefer 800 units or more, but probably not look at something less than 300 or 250 units. Now, don't even worry about why I said that. That's not important. What is important is I have a box and I created it based on my own opinion. Yours could be different, but create your box for your asset class you're going to look at first. And the better defined you can make that box, the more on track you're going to keep yourself. You're going to get less distracted and waste less time. And I'm most concerned about someone investing in the wrong risk profile or profile in general without them even realizing it. So those are the top 3 things coming to mind.
Awesome. And for those of you who are just like, oh my gosh, how do I start my box? What does this even mean? I did a boot camp at the beginning of November, and it is posted on YouTube. If you can't find it, just shoot me an email at whitney@passiveinvesting.com. In that boot camp, I walk you through how to understand your investing goals, your risk tolerance, and how to start setting up your buy boxes, right? Very important. So I'm so glad you said that, Jeremy. I was like, I got a resource for everybody on this. So reach out to me.
Very good. Very good.
So now that we understand what people should stop doing, let's understand what they should start doing. What are the 3 things they should start doing right now in order to start making this transition from, into full-time passive investing?
Yeah. So number 1 start for sure is education. It's funny. I was talking to someone the other day and we were pointing out the fact that, it's a very challenging time to invest right now for a multitude of reasons, but the current timing is literally probably the best time I could think of for learning since 2009. Because if you're taking the time to learn today and you're getting ready to understand what you're about to go into in the next 6 to 12 months, you're not missing much in the meantime. And that's what's really unusual, right? And we're in a very big transition right now. So if you can get yourself positioned with a lot of education on that first asset class, say, and then jump into that asset class when the timing may be very interesting next year, the year after, whatever your opinion is, I think that's a definite do right now. Education is key. And by the way, I have nothing to sell you. So I'm not like trying to sell you a course or whatever it is. I'm just telling you that right now, if you're new, make sure you get really well educated before you dip your toe in, because you want to 100% understand what you're investing in before you give it a try. And especially because it's illiquid. So once you pass down your money, it's actually illegal to sell your shares for the first year per the SEC, if you can believe that. And after that, it becomes very difficult to sell your shares, to find a buyer even in what you paid for it, et cetera. It's just complicated and hard. So just be 100% sure you get educated up front. That's very, very important. Yeah, go ahead. Sorry.
No, continue. I'm not going to jump in here. You're giving amazing advice.
Yeah. Another do right now would be, just do make sure you understand the risk reward of today's environment. So I know we talked about this in the don'ts, but I cannot stress the importance of formulating your own opinion about the economic environment, what your opinion about where prices are today. And if that sounds complicated to you, that's okay. But I think you need to get to the point where you have an opinion. It's almost like, imagine going to buy a house and the house is $462,000. and you literally have no idea whether that's a good price or bad price, how much was it last year, what's it going to be next year. These are the types of things you have to consider for these types of investments too, where you can make an easy mistake, right? And so understanding the fundamentals, learning about, formulating your own opinion about where we are in the economic cycle and which way prices are heading. In my opinion, they're heading down right now, right? Which is very important to know at least and consider. You've got to create your own opinion. It's actually great to listen to a lot of opinions, but in the end of the day, you want to create your own opinion and don't necessarily follow someone else's opinion, because there's 1,000 opinions and nobody knows which one's the right one. Nobody knows where prices are going, next month for sure. So that's number 2. Absolutely make sure you take the time to pay attention to the economic and real estate cycle right now. And number 3 would be, I would recommend, if you're unsure about how to network and all that, I'd recommend definitely learning more about the different options. I think right now is a really great time, because education is good timing, to consider going to conferences, to consider listening to podcasts, to consider going to in-person meetings in your area, or maybe just virtual meetings that are happening nationwide right now, which is a huge advantage compared to what wasn't available before, right? But I think learning what's out there as your options to educate yourself, and then potentially going down the path that makes sense for you. Right now, it's very good timing for that. And there's a lot of options. It's not just, okay, go and learn a course, right? I am a huge fan of going in-person meetings. If you live in a large city, there's a chance there may be one actually, or more than one in your city in a year. If you live in a large city, you can go to meetup.com. There's usually multiple meetings in large cities each month if you want to go in person. And part of the goal of going in person is education, but part of the goal for sure is networking. And the networking is much harder to do virtually than in person, unfortunately. And so, do make sure you research all your options. And depending on your schedule, depending on whether you can get away from your city, whether you can, there's all factors, but there's ways for people to learn. But don't just assume that you have one way to learn. There's a lot of different ways to learn in this space, thanks to technology right now. So make sure you understand them all, and don't go down one path because you didn't know there were 3 other paths that may have been better.
Yeah. And you guys, feel free to, we can't possibly cover all the different ways that you can network and learn on today's podcast. However, if you want to reach out to me directly, I'll be happy to share with you some of my favorite ways. Jeremy and I both will be at IREC in March. That's a great opportunity. We have our multifamily investor nation in June. There's for investors by investors. If you're on the West Coast, that's an amazing group. I've had the opportunity to stick with them a few times. And so, yeah, but that's not it. There's so many different, I know we have 4 just in the Denver metro area alone that I would totally recommend. Now, as somebody, and we're starting to get some of those tangible questions. So, as somebody's trying to figure out, okay, is this the right time? Is this the right market? what is my first asset class that I want to go into? What gathering up my education around this particular asset class, how can they start structuring their exit number? And I'm going to deep dive a little bit more into this in December as we go into our goal setting series for 2023. But how did you kind of orient to that? How did you go, okay, this is what I'm doing in my W-2. This is what I need to actually fully step away.
Yeah.
How did you come up with those numbers?
So I'll tell you what my comfort level is. Of course, this is very subjective, but the way I looked at it was that if I could be at 2x cost of living when I left the corporate world, that would give me padding so that if something stopped performing for some reason, or some cash flow stopped or became less, I was in a good position. My ultimate goal long-term has always been 3x cost of living, and I'm in a very comfortable place, right? Then you have, and I tend to invest in longer term deals, 10-year type timelines. So if you're in a 10-year type timeline across a lot of things, eventually a lot of stuff turns, but at the beginning, if you can get to 3x, that's a great place to be. I would strongly recommend, trying to get to 2x. Some people just shoot for 1x, and that's okay if you're comfortable with that, especially if you have some reserves, to be able to deal with the bumps. But I would say at least 1.5, if not 2x, would be great if you can actually achieve that. But I always look at it as a cost of living. And also very important, depending on what stage of life you're in, make sure you understand what your cost of living is really going to probably look like over the next few years, right? I can tell you when I left the corporate world in 2007, at that point, by the time I got out, I did have, I was living renting a pretty small place, and I was expecting 1 child. And I have to research, okay, what's this child really going to cost? Because today's cash flow is not necessarily going to matter for tomorrow. It's going to be different, right? And then are you going to have another kid in a few years? If yes, what's that going to look like, right? The last thing you want to do, and I will say the one cool thing is that I actually can't remember the last time I heard somebody get out of the corporate world with this strategy and have to go back, which is good. I don't ask around honestly a lot about it, but that's a very good sign. But the last thing you want happening is to end up with the freedom and control of your time, then to have to give control back, right? That's just not a fun thing to have to do. It's obviously a backup option and there's nothing wrong with it, but you prefer not to. Just make sure you're planning that accordingly for sure.
And that number is going to differ for everybody, right? Like my cost of living is different from your cost of living. Maybe not terribly different.
Well, I just want to say that's a very important point because I was living in LA, and I mean, I tell people the key to be a full-time passive cash flow investor is low overhead. It's just that simple, right? Because the more money you spend, the harder you're making it on yourself. And literally it's your responsibility to get to that point where you're covering the revenue is higher than expenses. And if you're just going to keep spending more money or be in a very expensive neighborhood or city, it makes it harder. So if there's one thing I could say, it's like, just try to keep your overhead as low as possible and make your life easier.
Sage advice. So how do people mess this up? Yeah.
So that's a really good question.
How do they get it wrong? How could somebody easily get this wrong?
Right. So I would say, to be fair, I was focusing on low risk, more predictable cash flow. That predictability is what I look for after the .com crash. It's the same thing for today with my personality. So the benefit I have, because I look for more predictable stuff that's, let's say, 80 to 100% occupied and already stabilized, is that I can look at a pro forma and expect some variance. It's never going to be exactly right, but probably within plus or minus 20% of someone's operating it well. In my experience, that's where it's going to be, right? And so unless there's some unique situation. And so in the way that I invest in a strategy I have, it works very well because I can actually plan out and hopefully have a reasonably high probability of getting a lot of this cash flow or most of this cash flow. I think where somebody could go wrong is if they happen to be a riskier person who is going to say, okay, I'm going to invest in 8 developments and I'm going to be living off the big chunks of gains that are coming from these, right? And then all of a sudden, the economy changes, the real estate market changes, the cost of construction goes up because of inflation. You were dependent on these big chunks of money coming out that were less predictable. And now that it entirely changed, and now you may have a problem. I would say to a degree, it's a similar situation if you're doing a lot of heavy value add, because again, it just like, it makes sense, right? So the lower risk and more stabilized the property is to begin with, the lower projected return on average, but the more predictability it has. And then as you go up the risk scale, you're going to have less predictability. So if you are going to go down this path, I would recommend probably being very careful if you're high risk, less predictable strategy, that's what you're comfortable with, because it doesn't necessarily mesh with someone, having to live off whatever that's coming from, unless you've got the personality for it, which is fine. But then you just have to be very careful and have adequate reserves at all times to make up for the lack of predictability. Does that make sense?
Absolutely. I mean, one of the things that I try to help investors, like on our one-on-one calls, understand, they may say, oh, I don't need the income right now. I want, a higher appreciative asset, maybe a development type asset, because I've got good income coming in right now. I don't need it for 5 years. And I'm like, but if you had the cash flow coming in now, it de-risks the asset, de-risk part of your investment because your capital is coming back to you. And say like in 3 years, there's a life event, something changes, there's a health issue. Now you can maybe flip the switch and start living off the cash flow. But if you don't have it there, then you can't, right? So those are kind of the way that, from a coaching perspective, that I help investors look at it. But I think that's great advice, especially in this type of environment that we're heading into right now. And there's cycles for everything, right? It's not to say that development deals aren't off the table. What I'm hearing you say, Jeremy, you just need to make sure it's the right, is it the right goal for you? And is it the right risk profile for you for what you want to do?
Exactly. And there's absolutely nothing wrong with someone saying, I'm going to stay in the corporate world for the rest of my life and I'm going to get this W-2 and I want to have higher risk because I'm already earning this income. I want higher risk to make higher reward. They may do very well in the long term, but trying to get out of the corporate world and depending on that cash flow, different story.
Definitely. So we've talked a lot about the risk and the choppy waters and what could go wrong, right? I always like kind of, putting, I'm an optimist, right? Like, what are some positive results that investors might expect from investing, even in this choppy water environment? What are some kind of silver linings or maybe some roses that we can look forward to?
Yeah, look, I think that if you're trying to avoid the ups and downs, there's a couple of things you could do. You could focus on less volatile markets. I was talking to a sponsor or an operator yesterday who invests in a market that doesn't go up very much. He didn't capture much upside in the past years, and now he's not going to be worried about it going down very much, right? It just steady, slow along, and it's a cash flow play. And so depending on how you create your strategy and what you're focused on, you may be able to get through recessions pretty well. And especially if you focus on either markets and or asset classes that tend to do well in downturns, right? And so there are some asset classes that are kind of known to be better than others during downturns, such as apartments, mobile home parks, self-storage. Of course, it's always location dependent, operator dependent, and frankly, even strategy dependent. If you buy a piece of land as a mobile home park, it may not do as well during a recession, but there are ways to mitigate that. So this type of investing can do really well during a downturn if you're choosing a portfolio a certain way, which can be really good going into this type of situation we might be heading into shortly. I would also say that the fact is that if you focus on diversification, you will potentially be very happy during more rocky times because you'll get probably a good amount of your cash flow, especially if you're on the lower risk side. And it's always really great to get that cash flow during a recession and a downturn. If you were in the corporate world, for example, you may have been having all kinds of other challenges or all kinds of cutbacks at work, and you don't know what's going to happen next. The next day you go in and all this type of thing. Again, I'm biased because I'm focused on predictability, but because I focus on predictability as opposed to the highest returns, those are the types of benefits you get, and they're going to be the most beneficial in the next couple of years, as far as I'm concerned.
Awesome. Well, Jeremy, we're kind of reaching close to time. I want to make sure we leave plenty of time for our after party section. What is the main idea or the most important thing that we can leave investors with their takeaway, the main takeaway from today's discussion?
Yeah, I would say the main takeaway is that if you're looking into this type of investing, one person's opinion, but it can really help to change your life. But I would tell you to go slow, get well educated, and especially at this timing, make sure you research this thoroughly and create your own opinion about whether it's the right time to invest or not and what to invest in to start that makes the most sense for you. And whatever you do, don't go into a deal unless you're 100% comfortable. And if that means, if you say to me, look, I'm only 60% comfortable because I'm new and I can't understand it well enough, go learn it and understand it better, because you're completely illiquid. And if once you're in, you cannot get out easily. So that's a very important aspect of really doing the research properly up front, both because of that aspect, but also because of current market conditions. Excellent. Jeremy, thank you for joining us today. Where can people find you? Yeah, sure. Easiest way to reach me is just through email, which is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com. Awesome. Well, guys, thank you. For those of you here live, don't go anywhere. If you're joining us on your favorite podcast or YouTube channel, be sure to join us for next week's session by registering at our Masterclass page. You can find that at passiveinvestingwithwhitney.com. And I'd be remiss if I didn't tell you guys, make sure to get registered there because on Thursday, we are going to be having a town hall session on self-storage. So guys, thank you so much for joining me today. We're about to kick off our after party.